And just go out.
So I'm going to start here, and then I'll just go. I'll just walk.
Okay, I see what you mean.
Yeah.
Hi, this is Mike Swanson. I'm here visiting the Bahamas with David Skarica, and we thought we'd do a video update about what's going on in the financial markets.
I guess just for interest sake, where we are is I live near a little town called Gregorytown, which is kind of in the north end of the island, and they have this cool little inlet, which is the dock here, and guys come in, they bring in the fish here. That used to be a school up there, but unfortunately got a lot of damage in a hurricane. And we were just at a little restaurant down the street for lunch, so decided to come here. And actually, it's really quite windy today. A cold front is coming through. So up where I live on top of a hill, and the wind is coming from the east or whatever, swirling around. So down here, kind of in this kind of levee or something, or this dock, it's much more calm, so better for the video. So, but anyhow, with the markets, we've seen this big rally in the last 6 weeks, and what's really interesting to me in this terms of this rally is if you go just look at the rally of September, October, and overlay of this rally, it's almost exactly the same. That we got this move that was straight down, and in August the move straight down was more for like a week or two. This time the move straight down was more for like 3 or 4 weeks, and then a few weeks of basing, and then the market went straight up for exactly 6 weeks, and then it kind of topped out back in the fall for a few weeks, maybe a month or two, and then rolled over. So that's kind of what I think is going to happen here. Mike can tell me if he disagrees, but the VIX is back down in the 14s, the complacency is back in. The investors' intelligence actually last week, for the first time, showed a jump back up in the bulls and everything. So I really think that we're just going to top out here and then roll over. And what's happened in this month-long period is the ECB upped their quantitative easing program from 60 billion to 80 billion a month. The Japanese central bank went more negative on interest rates, and I think this kind of caused this flush into stocks short term and kind of left the shorts kind of scurrying. But I think we'll kind of start to roll over maybe during the earnings period of April and go lower again. Because what's interesting is it'd be one thing like during the financial crisis, you have a decline in the markets and things kind of pick up and get better. But we're not seeing that. Like Caterpillar, for example, warned that the quarter is even worse than ever. So I think that what's happened is you got a mix of the central banks loosening even more. The Fed had a dovish statement, and companies were doing near record buybacks for this quarter, and that just pushed stock prices back up. And now that we're in this 2050 area in the S&P, I think we'll top out around here and then roll over.
Yeah, I pretty much think the same thing. To me, it's kind of interesting, too, that we have seen a big move in the past couple weeks in gold, which we both think is the start of a brand new bull market. Gold went from about 1050 to above 1250. The gold stocks, of course, have had a tremendous move. Stocks such as Barrick have gone from $7 to $18. And other commodities, interestingly enough, are also breaking out of their 200-day moving averages. They haven't gone up as much as gold has, but it does look like there's positive things happening. And these are tremendous moves that can last for years, because when a bull market starts, most bull markets go on for 3 to 5 years. So we see tremendous opportunities to actually make money by buying things in a position to go up for a very long time. That said, I'm afraid that this bounce to the stock market has simply made people once again get very complacent, as they were last July and last August, before that August flash crash type fall, but also as they were in November and December, because they did get scared when the flash crash happened, but then when the market bounced back up, their worries went away, and then it all dumped in January. They got worried again, and now they're not worried anymore. So they're kind of in this limbo about the market where they're not really making any real money. I'm talking about most people in the market. And yet they're not doing anything to try to figure out what's going on or take advantage of stuff like gold, stuff like mining stocks, which are doing great.
Like, see, what's interesting, too, is that this was an abnormally long bear market in gold and in commodities. Maybe because the bull market was so long. Because one thing we were talking about at lunch here is that if you actually look at the financial crisis, most of the commodities didn't start dropping till about the summer of 2008. So it was like, okay, it got slammed, like the gold stocks fell 70%, where the market was in the same time frame from the summer to the fall, maybe down 40, right? So that the gold stocks got slammed, but it was very short. It was like over by October 2008. It really was like 3-4 months, went straight back up. So we didn't really see a 1 or 2 year bear market in commodities, equities, gold, and gold equities, really, like, since, the last bear market of the late 90s. Yeah, so we didn't really see this, a long-term bear market, really since, the late 90s. And it's similar to the late 90s bear market, where the gold equities went down for about 4 years. This time they went down for almost 5 years. And this is really an abnormally vicious long bear market. One thing that made it even deeper in terms of price for these gold stocks was these companies made very bad strategic errors. And we're going to get on this for a second because how it relates to a stock market. Because they had all the access to all this cheap money. So they took over all these properties, they overpaid for them, they over-leveraged themselves doing these takeovers through debt. Well, that is what companies are doing that now. Some companies, like say Valiant, the biotech company, which is now blowing up, did the same thing with M&A and takeovers. But then some of the, in financial engineering that way, but some of the companies are just doing it through simple financial engineering, as doing excessive buybacks based on debt, with really debt that they won't be able to afford in the future. So that's just, by the way, the gold stocks are a warning for the rest of the stock market, because when the rest of the stock market went, so when the gold stocks went lower, one reason that made this bear market even deeper in them was all the debt the companies have taken on, and that is essentially what's going on in the regular stock market now. But now what happens now is that if you look at the history of these gold stock bear markets, this is how they end, is that you get this quick 50 to 100% move up in the gold stocks, and we've seen the HUI rally from 100 to 180, and then you consolidate a bit, and then you get the next move higher. And, the small producers have done really, really well. And even though Mike and I have been bears in the stock market, I can tell you with myself personally, some of the accounts I trade are up 30-35% just since December. And half of it was because I did cover some shorts, and the market, and our shorts did well when market really dumped for the January and the first half of February. But one reason we have this kind of performance is because I was in these smaller kind of producing gold stocks, and a lot of them are up 50, 100, 150% from their lows in just like 3 or 4 months. So one thing that we're going to talk about in our next video is, I think the next trickle down in these gold equities is going to be into these smaller companies, and I actually have access to buying these companies through private placements and financings and all this sort of thing, and I think that is really where a lot of money is going to be made in a gold equity bull market. So you don't want to just be so focused on one asset, but I think that when you have a bear market as long as it was in gold, with the decimation you saw in the stocks, and now there's a lot of value in the stocks, you really have to look at this sector. And that's why when I get an email from a guy who's a perma bull, I almost laugh at him right now, because I'm like, oh, big deal, like the S&P's off 12 or 13% from its lows, like up. And I'm like, many of these stocks I own are up 50, 100, 200%, so who really cares, right? So that will be interesting going forward, to see if this continues. But what I really think now is we're in this topping phase of this part of the bear market rally, and then the gold stocks, they may not do anything for the little short to intermediate term, but we're watching a fish kind of hop around over here. It's pretty cool. But the gold stocks will, at some point by the end of the year, see kind of like the second leg of the bull market higher, and you can see the psychology turning in them. You can see money flowing into them, and you like the GLD, which one reason gold went down so much was that ETF had something like 4 straight years of outflows. It had a record like 50 straight days of inflows without a day of outflows. So this are just signs that the psychology is turning, and the whatnot is happening. And right now, I would say I'm really in a waiting game. It's, do we see a correction in the gold stocks, a consolidation, and when does this bear market rally or rally in the stock market end?
But with the stock market, I think that what we've seen, as we mentioned before, a rally that's been similar to the one in the fall. And after such moves, typically what you see is the volume diminish and the market really stop moving up and down so much, and the volatility shrink, and then all of a sudden another big move will start, and in the bear markets those moves are down to the downside. So that's what happened in November and December following that big rally in October. The momentum fades and the market kind of drifts, and most stocks actually, when the market's drifting, actually start to decline. The market averages hold up and then you get a dump. So it seems to me that that's really what we're in store for with the U.S. stock market. One thing though I'd like to point out is last year people were really told that what they need to do is buy Apple and Facebook and Amazon and Netflix and Google, and at the end of the year they were told the stock market sucks on CNBC even, but buy these 5 stocks because these are the fad stocks, these are the momentum stocks. The year before, if you were watching Kramer regularly, he would be chasing restaurant stocks and biotech. So they tend to just tell you, chase these stocks, chase. But what's interesting is the FANG so-called stocks are now not performing as well as the market averages. The NASDAQ has not gone up as well as the Dow has. In fact, only 35% of the stocks in the entire NASDAQ have managed to get above their 200-day moving averages. So what we've seen in the rally is a move in basically the Dow, big caps, IBM, 3M, stocks that do these giant buybacks. But the previous momentum stocks before that are still the most popular stocks of people, Facebook and Amazon are the most widely traded stock according to Ameritrade, most widely traded 2 stocks. But these stocks aren't doing anything right now, and they're lagging the market. It's a warning sign that on the next drop, they're probably going to dump. The point about it, though, is that these are still the most popularly traded stocks, and it shouldn't be that way. Not for you, for goodness sakes, when we have these other opportunities to buy stuff that's not in a position just to go up for a few hours, or you hope the Dow goes up 300 points, you get a pop. We're talking about gold, we're talking about mining stocks, and it's going to spread into other commodities that are kind of not trading with the stock market at all anymore. They're just going up. Now, let me ask you this as we wrap up, though, about the stock market. We both have spoken a lot over the past, since July really, about shorting stocks. We've been betting against stocks. In that arena, do you think now is a good time for people to make some new bets against individual stocks? And what are you looking at?
Yeah. In terms of shorting, actually, what I did in my service is I had a bunch of two things. Number one, I had a bunch of 3X ETFs. Now, I usually don't like them because of the erosion, but last summer I just figured, you know what? There's no volatility in the stock market. We're just going like this. We're not really breaking out. The sentiment is too really positive for us to have a huge move to the outside. I'm going to buy to 3 times biotech, or 3 times semiconductor, 3 times small cap, these sort of ETFs. And really, I solely sold them as the market went down. They went up, and I made about 50 to 100% on most of those trades as the market slid, and these 3X bear ETFs. So we did that, and by basically middle of February, I was totally out of those bear ETFs. And then we had a bunch of put options, and some of the stocks that I had puts on, I was looking for stocks that were financial engineered, seeing signs of slowing growth, could get whacked to the downside. So we sold a lot of those puts too, that have kind of reinvested slowly over the last a month or so. So what this happened was there are certain stocks, you're mentioning restaurant stocks. There's one restaurant stock that I didn't think I was short again because it had fallen so much, but it had a huge rally on this bear market rally, and I was able to get back into it. And some of these other tech stocks, say, are rallying back towards their moving averages. Now you can short them again because they're no longer oversold, and if anything, they're overbought, right? So that's the kind of thing that I like to look at and do. So I think right now you're getting some of these great opportunities. And then I'm a real contrarian and kind of shorting. I don't think many people do this. I like to short these parabolic stocks, these stocks that are totally blowing off to the upside over a lot of hype and the whatnot. And one, for example, that worked out was I shorted Skechers last year at north of $50 a share in our service, and it's trading in the low 30s right now. And that stock was straight up. We were shorting it, and the earnings are great, and everyone was bullish on it. Kramer was pumping it, Zacks was pumping it, everyone was pumping all these kind of stocks. And then I got another stock right now that's doing kind of the same thing that we just kind of put a short on. So you got the combination where the rallies caused some of these parabolic stocks to see their final move higher, some of these beaten up stocks to rally and no longer be oversold. So I think actually there's a lot of opportunities. Now, because of what gold's done, and now gold is showing signs of being in the early stages of a bull market, I'm probably more optimistic and excited about what's going on in gold, precious metals, and some mining stocks than I am my shorts. But I think shorting still has to be a huge philosophy, and here's the way I look at it. Because even though I'm getting into these gold stocks, and we're going to talk about, like I said, in the next video about these deals, what I really am excited about and is that the shorts, even if, say, the market tanks and took the gold stocks all down with them, well, my shorts will probably hedge that entire loss, and I'll still end up making money. So I think the short-long philosophy with these sectors that are beaten up, coming out of the bottoms, like the precious metals, along with shorting a lot of these bubble stocks that are now rallying back to their moving averages and no longer oversold, I think that's a great trading strategy right now, and something that I'm pretty excited about on both ends of it.
Let me ask you this at the end here. As we do this video, and I'm going to send it out, we'll do a special offer for people to get into your premium trading service. Could you tell people what they can get once they do that?
Okay, so what I do is, as our monthly subscriber, I actually have 3 tiers. I have a regular newsletter. We're phasing just the regular newsletter out because I want to be more focused on the trading and the shorting and doing these deals. But the regular newsletter is part of it. So you get a trading service. I send out email updates. In terms of our option trading, we give you the exact date, expiration price, how many contracts that I'm buying in the service. I basically have a model portfolio that's $100,000 invested in a combination of stocks and options. So like I'm saying, say we buy $1,000 worth of option contract as this, we're saying that's 1% of the trading portfolio. So that would be, if someone had an amount to trade with, they would do 1% themselves if they wanted to, right? So we have this kind of model portfolio. Then in the shorting service, we have a model portfolio based on having $250,000 to short. And really the idea is we will have up to about 50 or 60 shorts with the maximum of 5% in one short. So $5,000, or $12,500 in one short. Most of the shorts we do are, say, 2 or 3%. I don't like to be overexposed. So we have the short portfolio, this option portfolio, and the thing we're just setting up, which we're going to talk about in another video, is buying into some of these private placement opportunities and the whatnot. So that's basically what we do. And obviously, too, I also recommend stocks and that sort of thing. And like, for example, one advantage you'll have with me is I really know the junior resource market. I traveled to the trade shows for that market for 15 years. I used to speak at all those. I know tons of people in it. And again, a lot of the smaller junior producing companies or companies with large resources that we picked actually went up 50, 100% during this move in gold. So what I'm looking for now is to trickle it down to some of the smaller exploration companies and leverage even more by buying some of these private placements and the whatnot. So that's kind of what we give. So I think the advantage I have is I'm not just going to tell you to go buy Newmont or something. I'm going to give you these smaller companies that have more leverage in a bull market in precious metals, and then plus you mix it in with our shorting. I think that the shorting mixed with that makes it really, really unique in that most of these guys who are gold bulls or run resource things, they just recommend stocks. We can kind of like hedge at the same time where we're buying put options on stocks we think can really fall and then go long sectors we think we really like. You know, oh, and basically, Mike and I sell it for roughly $100. I think it's 97 bucks a month.
Yeah, so go click below this video and check it out. I get this material and use it myself, and I think you'll find it very valuable too.